because most banks and regional banks and stuff don't have a national footprint. They have a local footprint. So that's the real beauty of SBA, is that these banks are very, very hungry to fund these deals because they make a lot of revenue from it. I mean, the point of it is it's supposed to create jobs and help small businesses of America, but really it's a money game like anything. Unfortunately, the good of it is it does create jobs and everything, which is true. But when it comes down to it, most people are looking at the money game out of this, which is kind of how the world works. I do think all in all, though, it does create a lot of opportunities and it does drive the economy. The more small businesses that launch, the more money comes into the economy, the more people get hired. So it is, all in all, even though it is a money game, it is good for our society and our economics.
Hey, Beau, how's it going?
Going well.
Awesome. We're going to talk today about, trying to buy a business with no money down using SBA loans and other sorts of financing like seller financing. Can we just jump right into it?
Yes, let's do it.
All right. So is it really possible to buy a business with little or no money down?
Yes, the answer is yes. There's definitely caveats. One is it's got to make sense, right? The business obviously has to be strong, the cash flow. The seller can carry a portion of the down payment that we call it a seller carry on full standby. They can carry usually 5 to 7.5% of that 10% requirement as an equity injection. So let's just say they were doing 5%. The bank's going to lend 90. Well, you need to bring in additional 5%. That could come from an investor partner. So we structure deals like this all the time. So it's very possible to do this with little to no money out of pocket. Now, the deal still has to make sense. Like if they pull your credit and the highest credit limit you have is $2,000, you don't really have a credit report that shows repayment history. A bank could say, "Hey, you're asking to buy a $5 million business, and you don't have the experience in the sector." All these things can play into the fact, but generally we're able to get deals done that you'd be surprised they get done even with low liquidity, but they've brought in investors. I talked to a guy the other day and he's buying a HVAC business for $5 million and he was only bringing 50,000 of his own money. And he was bringing an investor in for 450,000. So you can be extremely creative. We've done deals where my wife invested in, and on that particular deal, she owns 19% of the business, and the main borrower guarantor didn't put any of his own money. Now he signed a personal guarantee, and he's the main borrower. So to answer those questions is yes, you can, but it's got to make sense. Everything has to make sense, but it is very doable. That's what's crazy about this world is you can take somebody who's making 80 grand a year, doesn't really have that much savings, maybe they have a decent resume, and they find a deal. And then they move into this new deal where you own this HVAC company where it's got the last couple of years has paid their owners $300,000 salary. So it's very possible on one deal to make a big move. And that's what's amazing about SBA financing.
So you kind of alluded to this in the last answer, but how can seller financing be combined with an SBA loan? How does that work?
Sure. So let's take $1 million acquisition. 900,000 comes from the bank. There's 100,000 equity injection. Most banks want 5% equity injection. So seller carries 5, you still need 5. I do have some banks that are okay with 2.5% in the deal. Not many of them want to see the no what we call no skin in the deal from the buying side, but it can be done. $1 million purchase, $900,000 is the SBA financing, assuming the business cash flows. We need $100,000. The bank says, okay. The seller says, look, I'll carry back a portion of that on a seller carry note. It's got to be on standby, so it's either got to be an interest-only payment or no payment, but it can accrue interest depending on if it cash flows with that debt service. So essentially, the seller's leaving some of their equity in the deal, and it's got to match the term of the loan. And if it does, then you can do seller on standby. So if the seller said, yeah, I'll do 7.5%, That means $900,000 bank loan, $75,000 seller carry note. You need a $25,000 equity injection to close the deal. That comes from could come from an investor partner. And if you have enough outside cash flow and you have equity in a home, you could even use a HELOC, an equity line of credit, as your equity injection. It can't be borrowed funds, but if it's coming from an equity line, that's okay, because that's like equity out of your property. As long as your outside income can support that, then that's fine. And if you we've done it where the individual didn't have a job, like got laid off in tech and was like, I'm just going to buy a business. As long as there's a salary that's caked out and there's enough money that spits off from that business, that person, that buyer could take that salary, and that could surpass, for a lot of people know DTI, debt to income. We call it global cash flow. So we can actually use the cash flow even if somebody didn't have a job per se. So there's a lot of cool things you can do with SBA financing.
Wow. So what are lenders looking for in a deal like this? Like, I guess what's in it for them, right?
On an SBA 7A loan, the majority of the banks or lenders sell off the guaranteed portion. So depending on the loan amount, depends on the guaranteed portion amount. It's based, there's like a matrix. But let's just say it was a 75% guarantee. So on $1 million loan, that's $750,000. The day the deal closes, they sell that guarantee, that $750,000 guaranteed piece off for an 8 to 12% premium day one. So multiply 750 times 10%. That's what they get the day one, on top of servicing and everything. So it's extremely lucrative for the lenders, extremely lucrative. That's why lenders love these types of deals. That's why you see some little small community banks, and they have a national footprint, and they do a lot of SBA, because most banks and regional banks and stuff don't have a national footprint. They have a local footprint. So that's the real beauty of SBA, is that these banks are very, very hungry to fund these deals because they make a lot of revenue from it. I mean, the point of it is it's supposed to create jobs and help small businesses of America, but really it's a money game like anything, right? I mean, at the end of the day, just like we talk about CPACE financing, like state-enabled program for green energy. Why do developers really use that product? Not because they really care about green. It's because they care about the other green, money. So unfortunately, the good of it is it does create jobs and everything, which is true. But when it comes down to it, most people are looking at the money game out of this, which is kind of how the world works. I do think, all in all, though, it does create a lot of opportunities, and it does drive the economy. The more small businesses that launch, the more money comes into the economy, the more people get hired. So it is, all in all, even though it is a money game, it is good for our society and our economics.
Yeah, of course. Can you share a real world example of a creative deal structure that worked?
All the time. I mean, we do low down deals all the time. We do deals with very low. So the deal my wife invested in, she owns 19%. The main guarantor put none of his own money in it. That's a real example. It's a $2 million acquisition. We got a little bit of seller financing. There was a couple different investors, each owned a portion. My wife owns 19%. Our other business partner owns 19%, and the guy's brother owns 14%, and then the guarantor owns the additional whatever it comes out to 51% or more. He came in with no money. So, case in point, that's just an example of how this program can work. Not encouraging people to do zero down deals, but if you found a business that was cash flowing and you could go from your job that you hate into a business that can potentially be a legacy for you and your family, it's the way to go. It's the way to go, in my opinion.
What advice do you have for someone trying to structure their first acquisition?
Learn. Read Buy Then Build by Walker Diebel. That's a great book. Watch, go to events. Just like any other thing you want to get good at, you got to study. Build a buy box, look at deals, understand financials. You maybe even take some classes on reading balance sheets and profit and loss and understanding cash flow from that perspective, getting in in with the lender so you understand how to underwrite a deal from a lending standpoint for SBA. And then, make a lot of offers and then hopefully find one and then jump in and do due diligence. Make sure you have transaction attorney that has experience in that realm, a good lender, closing attorney, if needed. If you're doing a big acquisition, you might want to look at doing an equalities of earnings report, and then understand the business, really get in and spend time understanding how it works. And also realize that there's usually a dip in revenue on a business acquisition between 2 to 5% initially. Usually they ramp back up. Anytime there's a change of ownership, there's going to be a revenue decrease. A lot of people don't talk about that, but I think there's studies out there that show like 70% plus business acquisitions revenues dip. Now they usually come back up and then sometimes even do really well, but you just want to be aware. And you also really want to understand the concentration of the business. If you have only one customer that's buying your widget on a business that you're buying and that customer goes goodbye, your business is shut down. So you don't want to have a huge concentration of whatever that, if you own some sort of buying a manufacturing business and you have only 2 customers, what happens if one closes down? You lose 50% of your revenue. So understanding customer concentration and all that stuff, understanding the sector, that's why you really want to define your buy box, just like buying real estate. If you're a multifamily investor and now you're trying to buy self-storage, it's a different food group. You got to underwrite differently. Same thing with a business acquisition. If you're looking to acquire a business, stop scrolling on Biz Buy Sell and visit franchiseresellelistings.com. We'll do a customized search. You can get on our weekly distribution where we're sending new inventory weekly to your inbox. So visit franchiseresellelistings.com and opt in today. See you there. Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.